main points that I want to make today are related to my view that the core of the financial system was prone to failure coming from any kind of major financial shock. It didn't need to be a housing market shock. The system was set up to fail, not on purpose, of course, and I want to explain why I think that's the case. So let me just give you my first factor. It happens to be in the poll that Anil and others at the University of Chicago have set up of around 40 US and 40 European economists. I'm one of the US, I'm actually Canadian economists that were polled. The first of 12 factors that were listed in importance as relevant to or creating the conditions for the financial crisis was, quote, flawed financial sector regulation and supervision. And I sincerely believe that was the primary cause of the system being set up to fail. And I'm going to focus especially on supervision. I actually think there were probably enough regulations on the books to keep the core of the financial system in a safe place. But the regulators didn't do that. And I want to try to get at least not all the way to the bottom of that, because there are several hypotheses that I'll contemplate, but I want to get as far as I can down into that. So let's just start with the conditions in the core of the financial system. And I'm going to be focusing mainly on the big banks. This is a big bank story and the markets that connected the big banks, the big interbank markets for short-term credit, for derivatives, and so on. Okay, so the banks on which I'm going to focus are the 9 big ones. And before the crisis, they were split into 2 groups that were called investment banks. That was Goldman Sachs, Morgan Stanley, Lehman, Merrill Lynch, and Bear Stearns. And before the crisis, the other banks were known as commercial banks, Citibank, Bank of America, JP Morgan, and Wells Fargo. Now, Wells Fargo is not going to figure prominently in this story because they were not as active in the kinds of markets that I'm focusing on. But collectively, you can see the leverage of these banks on this screen. And the investment banks stand out. They're in the blue line at the top for the extreme levels of leverage that they had. Now, gross leverage is not everything. We're going to get to risk in a little while. But this should already have been a warning sign that there was a lot of risk in the core of the financial system. And don't let the scale fool you. The other banks, so-called commercial banks, were also extremely highly leveraged. You just don't see that their leverage has come down by almost a third since the beginning, since pre-crisis. And by the way, these so-called commercial banks, I'm referring to the bank holding companies. For 3 of these banks, the bank holding companies included enormous broker-dealers. And those are JP Morgan, Citi, and Bank of America. So a lot of leverage, but very low pre-crisis credit spreads. That is, this is the 1-year LIBOR OIS, which is basically a measure of what creditors were asking above risk-free rates for giving credit to these banks. And pre-crisis, it was on the order of 10-ish basis points. Now, if you think about the amount of leverage, and if you knew about what wholesale markets knew at that time about the risks inside these banks, you might be surprised that these banks were getting credit, even at 1 year, at 10-ish basis points, and at 5 years, at between 20 and 30 basis points. Those are razor-thin credit spreads. Note, not only did the credit spreads jump up post-crisis, but after the banks became much better capitalized, they never came back down to pre-crisis levels. And I'm going to make the case that this is associated with the belief of creditors pre-crisis that the banks wouldn't fail, or at least they wouldn't be forced to take a loss if they did, because the banks were too big to fail. This is the total size of the assets of these 9 banks. And I've split out the investment banks in red. Of course, 3 of them disappeared entirely or into the other banks after the crisis. But you can see the red assets are growing really fast, even compared to the blue, which are also growing very rapidly pre-crisis. So the moral of the story here is if you give the banks extremely cheap credit, it's like subsidizing gas down to 5 cents a gallon. If the gas is really cheap, you're going to drive a lot. If credit is really cheap, you're going to build enormous balance sheets. This is the flowchart to failure. This is basically the story of the paper. Let's start in the bottom center. Suppose creditors believe in bailouts. Or if you pick up Andre's story, suppose at least they don't believe that there's going to be a significant problem. Then market discipline will fail because, as I mentioned, the banks will get credit incredibly cheap and they will build up enormous balance sheets. They will become prone to fail. Now, there's a safety check, or there's supposed to be one, which is that regulators are supposed to be supervising these banks. But if regulators supervise weakly, which I claim that they did, then that also sets up vulnerability of the biggest banks to failure. And again, coming from many different kinds of major shocks. This is not to say that the housing crisis wouldn't have caused a recession or some major problems like the dot-com bubble burst, but that the core of the financial system didn't need to collapse to the extent that it caused the economy to crater like it did. That is, that the losses that occurred in the financial crisis were much bigger than they needed to be, and that the failure of these largest banks, as Ben Bernanke's paper coming out in the Brookings in September will document, the failure of the largest banks generated extremely large losses in the real economy. So, in Andre and Nicola's words, what were they thinking? I actually appropriated that title for this slide from chapter 2 of their book, which is excellent, and I listed at the top of the list what Andre just described in the first session, which is a rationally low belief in disaster scenarios. And that's already been well covered. I want to turn to some other, not mutually exclusive, possible explanations for allowing the financial system to be set up for a failure. And one of them was the point made by Steve Haber, my Stanford colleague, and Charlie Calamiris, which is that the system was, quote, fragile by design. Now, that doesn't mean that they tried to make it fragile. It means, in their words, and I'll quote, financial crises occur when banking systems are made vulnerable by construction as the result of political choices. So it's a political economy story that in the United States, as opposed to other countries like Canada, Australia, and some of the others that didn't have such a major banking crisis, in the United States, political choices overwhelmed the structure of the regulatory system and the decisions by regulators. Third possible explanation, this reliance on market discipline that I illustrated in the flowchart to failure. And I'm going to give you a quote from a speech by Alan Greenspan in 1997 about that will signal the extent of reliance on market discipline that was rampant, in my view, in the regulatory community before the crisis. As early as 1997, when he said, quote, as we move into a new century, market stabilizing private regulatory forces should gradually displace many cumbersome, seemingly ineffective government structures. And he went on. And that sounds very Greenspan-like. And I'm going to pick up this story of market discipline and the failure of market discipline towards the end, but I want to move on. The next possible hypothesis is it was just too difficult, within reason, for regulators to detect the problems that Andre described this morning and that I'm going to be describing today. After all, of the many financial experts in this room, I don't know of any, and I'll include myself there, that were waving their arms saying, the facts are in plain sight. We're heading for a financial crisis. Regulators, do your job. And we had plenty of incentives, at least as scientists, to uncover the facts, and we didn't. So maybe we were subject to the failure that Andre pointed out this morning to put proper weight on disaster outcomes, or maybe it was just too difficult. Lehman's Repo 105 was an example of the banks hiding their financial conditions. Last one, which I want to focus a fair bit of time on, is the failure, and this is consistent with the Calamiris-Haber hypothesis, the failure of the legislatures to assign to the regulators a clearer financial stability mandate. And Don Cohn, in a 2014, I think, essay for Brookings, suggested that every regulator on the US Financial Stability Oversight Council should be explicitly assigned a financial stability mandate. I want to focus specifically, most specifically, on the Securities and Exchange Commission because they were the ones that were supposedly overseeing those 5 large investment banks pre-crisis. Here is a chart showing on the left for each bank. This is Morgan Stanley, Lehman, Bear Stearns, Merrill Lynch, and Goldman Sachs. This happens to be 2005, but this is typical of pre-crisis. On the left, the actual net capital, which is a calculation that these banks had. And on the right, in the solid red color, is the SEC's required net capital. Now, if that seems pretty low relative to their actual capital, it is. On average, according to some research by Kai Giesecke and Michael Olruge, the red bars were, on average, in the pre-crisis year across this panel of banks, about 12% of the actual capital. In other words, these banks were essentially running unconstrained with respect to their leverage. Now, there is this pink overlay above the red. This is the early warning zone. If a bank enters into the pink, it's required to report to the SEC that it's entered into the early warning zone. And these are remarkably small numbers. If you look at the required net capital, they're basically $1 billion or much less. Why so little? Because the philosophy of the SEC at that time was not so much to prudentially supervise for the failure of these financial institutions, rather it was to protect the customers of these financial institutions from losses associated with their customer relationships. Let me give you an example quote. Michael Halloran, who was the senior advisor to the chairman of the SEC in 2007, first quarter, this is his testimony to the Financial Crisis Inquiry Commission, said that he asked the head of the Division of Trading and Markets of the SEC, this is the division of the SEC charged with supervising these 5 institutions, he asked, why can't we make them reduce risk? And according to Halloran, the reply he got was, quote, the SEC's job is not to tell the banks how to run their companies, but how to protect their customers' assets. I reviewed a law article by Gadinas that showed of 545 pre-crisis enforcement actions by the SEC, only one was somewhat related to capital or liquidity of these institutions. Now, where does this focus on protecting investors come from? Well, I'm drawn to think that this goes back to the Great Depression, when the Pecora Commission uncovered enormous abuses of investors coming out of the stock market crash. And in a storm of political outrage, the Pecora Commission led to setting up the SEC, whose primary role was basically to protect investors. And in my view, this mission continues. To give you a more recent example, the Madoff scandal, which was an investor protection problem, generated an Inspector General report at the SEC, voluminous, 457-page report. The failures of the SEC to supervise these 5 banks leading into the crisis generated a 27-page report with a rather, I would say, stingy, grumpy response from the head of the Division of Trading and Markets. Now, in the remaining time that I have, I want to turn to the markets that connected these financial institutions and how they were also prone to failure. And I'm going to focus first on repo markets. The reason I'm going to do that is that in the United States, there is extremely heavy dependence on bond markets for running our financial system. The top black line in this chart shows the fraction of credit provided to the US economy, not by banks, but rather through capital markets. And that includes bonds, securitizations, commercial paper, and so on. And you can see that a collection of other currency zones or economies require substantially less. China is growing from 0 rapidly towards the median. So the US depends very heavily on capital markets, and those 5 investment banks and the broker-dealer subs of the large commercial banks basically intermediated that entire system, both derivatives and securities financing and trading. And I am going to disagree with Andre on the importance of short-run debt. I do think that Doug Diamond's claim that private financial crises are everywhere and always due to problems of short-term debt does play a significant role here. The question is, what kinds of markets for short-term debt are important? And I'm going to focus on repo. The vertical axis on this chart is the amount of daily financing provided to the largest banks. These are the primary dealers, pre-crisis. The blue line is overnight and continuing, which means the money can be pulled on 1 day's notice. And you can, the scale is kind of scary. It goes up to $3 trillion. And the blue line is growing a lot faster than term repo, which is longer term. This enormous buildup of overnight credit was flowing through a rickety, I'll put it that way, set of market infrastructure, which I want to explain. This will take a couple of minutes, so be patient. There's a lot of plumbing in this diagram, but it might be worth it. Let's start in the green, the large green dot in the middle is the money market mutual funds, who supplied a lot of, not all, but a lot of the overnight financing to the major dealers. And those major dealers on-financed through to the rest of the economy. The money market funds were getting that cash from large cash pools and to some extent from retail investors who had alternatives, which were to go to the banks or to go to the securities markets directly. When the major dealers got into trouble, the money market funds could pull the money. And even if the money market funds managers didn't pull the money, their cash pool investors could pull the money. And that's exactly what happened when Lehman failed. Within a week, $300 billion of financing had disappeared from the prime money market funds, which was going directly into the major dealers. Even worse, intraday, that financing was offloaded to 2 systemically important banks, JP Morgan Chase and Bank of New York Mellon, which carried that financing over $2 trillion intraday. In my paper, I document what might have happened had one of those 2 clearing banks been destabilized from the failure of a major dealer intraday. Had it not been for the very swift and nimble action of the Fed and the Treasury to provide enormous amounts of emergency lending and for the Treasury to guarantee the money market funds, these are events that we don't like to see and which are difficult to arrange now, the financial crisis, as deep as it was, would have been much, much deeper. Now, I want to turn to the other major market on which I'm going to focus this morning, which is the OTC derivatives market. This slide shows the size of the market, not in notional, because you've seen the hundreds and hundreds of trillions of notional, and you kind of wonder what that means. This is actual market value in dollars of these positions, growing exponentially pre-crisis to about 30 trillion. So, well, again, what were they thinking? Well, in 1998, Brooksley Born, commissioner of the CFTC, suggested that this market ought to be regulated. This was back when the market was of a manageable size. And there was pushback. Alan Greenspan, Robert Rubin, and Arthur Levitt, the heads of the other 3 main relevant regulatory bodies, said, no, we don't want to do that. And they proposed what they called broker-dealer light. Broker-dealer light meant no margin requirements, no central clearing requirements, no reporting requirements, and at the time, there was pretty light capital requirements on the derivatives market, so it's not surprising it soared. Notice that these gross market values come down post-crisis. This is with the imposition of Dodd-Frank and Basel heavy requirements on this market. The fears that Greenspan, Rubin, and Levitt had that regulation would stamp out the vibrancy and activity in this market is not justified. Although the gross market values came down, the market activity kept going up. The reason the gross market values came down is that the banks were a lot more careful about loading up unnecessary derivatives on their balance sheets. They used central clearing and compression trading to reduce the amount of balance sheet they needed to run the market at greater and greater levels of activity. So the market survived. In my last few minutes, I want to come back to market discipline. Thanks, Jim. This is a chart from some work I'm doing now. It's very preliminary with Antje Berndt and Yi Chao Ju, who are at the Australian National University, showing the degree of solvency of these 9 institutions starting in 2002 and coming up to early this year. And the scale is the following. Tangible common equity divided by an estimate of the standard deviation of change in market value of the assets within 1 year. That's a mouthful, but it basically means how many standard deviations you are from failure. Okay, so pre-crisis, pretty close to failure. Post-crisis, way far from failure. And yet, in our study, we show that credit spreads have gone up, not down. Safer banks, but higher credit spreads. So what's the story here? This chart shows the credit spread at 5 years of one of these 9 banks based on a fixed distance to default, same kind of metric I just gave you, which happens to be 2 standard deviations from default. Pre-crisis, that fixed quality bank had a credit spread at 5 years of about 50 basis points. Post-crisis, around 150 basis points. What happened? Well, in my view, it is not the failure of imagination of investors to believe that the banks could approach insolvency. Rather, it's their loss of faith that they're going to get bailed out. Both the failure of Lehman and post-crisis regulations, Dodd-Frank and in Europe, the Bank Recovery and Resolution Directives, stipulate that these banks will fail. That is, they will not be bailed out, and that the creditors, the wholesale creditors, will take losses. Now, whether you believe that the regulators can pull this off, or actually would even be willing to hit the button, it doesn't matter. What matters is that creditors believe that they could take a loss. If they do, they will no longer supply razor-thin credit spread, cheap debt to these banks, and market discipline will have a chance, at least, to work. The numbers seem to bear out that we have one of the elements in the flowchart to failure stopped, and that is there is some element of market discipline that's been reimposed on the market. That's not enough. The other key pillar of financial stability is that the regulators are given and accept a mandate for financial stability. And I think, while I'm not at all concerned about the Fed based on their post-crisis self-examination, their commitment is very high, I'm not so sure about some of the other regulators.